So chapter 6 looks a little bit deeper in inventory. We're going to look at learning objective 1 first, take a break, and then we'll come back and finish learning objective 2. Okay, so learning objective 1 should, most of it, like I said, about 90% of it is a review from all the stuff you learned about chapter 5, about how inventory is classified and determined. We've been focusing on merchandising companies, right? Those retailers with one way of classifying inventory. Merchandise inventory is an asset account. However, in your next class, Accounting 204, the managerial accounting, we're going to be looking at inventory from a manufacturer's perspective, in which case there are 3 different ways in which manufacturers look at inventory, including raw goods, work in process, and then the finished goods. So you'll be getting a lot of this in the next course. So be prepared. You already know and been introduced to the fact there are 2 main systems. The perpetual inventory system, again, a consistent consistent updating of the inventory records. Most stores have that because most stores are computerized and scan inventory both in and out. So they know exactly what's on hand. At least they have a computer record of it. And then there are smaller stores that do a periodic system, which literally at the end of a particular period, they will literally count the goods. So we call that a physical inventory. But guess what? Physical inventory is going to be done in both systems regardless. Because even for those that have a perpetual system that are keeping inventory records electronically, you have to stop periodically and verify that the accounting records, the computer records, are accurate. And the only way to do that is literally to physically count the stuff. Okay, so that's what a physical inventory is done. We usually do a physical inventory when the business is closed or when it's a very slow season, and so there's not much else going on, and we can actually concentrate in getting a physical count. We also will take a physical inventory at the end of an accounting period because we want to verify our inventory, which is an asset, and our cost of goods sold, which is an expense. Remember all the stuff about ownership that we talked about in chapter 5. It's coming back here. What's important to know is when you are physically counting inventory, there may be some goods that are in transit, right? They haven't arrived at your destination yet, so they're not physically there to be counted. But if you bought those goods FOB shipping point, you own them, even though they're on a, plane, train, automobile, whatever, truck, what have you, and coming to you, you still own them. And so you have to count those goods that are in transit as part of your inventory. Okay. So again, most of that happens during an FOB shipping where the buyer actually owns the inventory once the seller puts it on the carrier, right? So the buyer owns all of this even though it's in transit. So if you own it, you have to have it as part of your inventory. You have to count it as part of your inventory, even though you may not be able to physically count it because it's not at your location. That's not going to happen with FOB destination, of course, because the ownership doesn't happen until it gets to your destination. So you will be in possession of the goods as you're counting it. The only thing that doesn't have, what affects inventory is something called a consigned good. So a consigned good is something that you have allowed the owner to either rent some shelf space to display their goods and sell them in your store, or most of the time it's you're allowing the owner to have their goods in your store, but you're going to be taking a fee every time those goods are sold in your store. Okay. So just because you have all these other goods in your store If it's a consigned good, you do not own them. So although you'll be counting them, they're not yours. So that's something that's going to be new. And this is very true for many different dealers, car dealers, boat dealers, antique dealers. Very common to have a lot of goods on consignment there. But that's also true in a supermarket. In a supermarket, you'll have, the soda aisle is, Coke and Pepsi and Cadbury Schweppes. They're the ones who take care of stocking all the shelves there. The same thing with the chip aisle, with Frito-Lay and others. They're the ones that were stocking all those things. And the bread aisle is often very similar. So even though those goods are in the supermarket doesn't own them. They didn't have to buy them before they sold them. They will just simply take a fee, a percentage of the price, once every Coke is sold or a bag of chips or other types of things are sold. Okay. So consigned goods are different. And that brings us to the rules of ownership in a wrap-up of Learning Objective 1. Good example here. This particular company has done a physical count. They've done their inventory. And they have arrived at a $200,000 value for the inventory in the store. However, there's information that has to be sorted. One is there are some consigned goods that they counted, $15,000 worth of consigned goods. So if it's on consignment, they don't own it, and so they're going to have to take that 15,000 out. The second thing that's noted is the company had purchased goods of $10,000 that were in transit. They owned them as soon as they got on the carrier. And so here, just because they're in transit, they're not going to be physically counted because they're not there yet, but they have to be counted in the inventory. So we're going to be adding that in. The third piece of information is the company did not include inventory that had been sold for $12,000, which was already gone. So that's good. That's good because if you sold it and you sold it FOB shipping, as soon as it's been in transit, you don't own it anymore. So clearly, it's not going to be part of your inventory. So what would the company need to do here? The company would need to, again, take out the $15,000 of consigned goods, add in the $10,000 of goods that they bought, but they're in transit. And that means that the real inventory from this physical count is 195,000. Okay. So again, very important to understand where ownership takes place. And just because you're doing a physical count, sometimes you own something that's not physically with you. You have to make sure you're taking in consideration of that. And if you have things on consignment, just make sure you know how much, because you're going to take it away. So that's learning objective 1 in a nutshell. Questions? So learning objective 2 will introduce you to what we call inventory cost flow methods. So again, they buy inventory at a certain price, the cost to the business, and inventory starts as an asset. But then once inventory is sold, that becomes a cost of goods sold, it becomes an expense. The question becomes, which items do you expense? Remember, you start the year with certain beginning inventory in the store, and you're buying inventory all the time. So as customers come in and out of the store and buy stuff, you have to subtract out a cost of goods sold, but which one? What cost? Well, that's what this is going to give you an idea about. We're going to focus on 3 of the major cost flow assumptions for inventory. And when we say cost flow, how we cost it out once it's sold. Okay. The most popular assumption that's used is something called first in, first out. The FIFO method is the first one you're going to be introduced to. The next, and this is the most popular for sure, almost half the companies out there use the FIFO method. A very solid second place is something called the LIFO method, the last ones in are the first ones out. So you're going to learn about that. And that's a solid number 2 in how companies work. And average cost is the last. There is a fourth one that we have called specific identification, except we're not going to be learning that in this particular course. But it's a cost flow method, so it's real. It's just that it's not very common. So the ones that we are going to be focusing on, as you see, FIFO is clearly the leader here, LIFO in second place. So let's find out more about FIFO and LIFO and average cost. In order to understand any cost flow method, you have to have the inventory sitting in front of you. Otherwise, none of these things are going to make any sense to anybody. Okay. So it starts with an inventory list. So this is a company, Houston Electronics. They have this product called an astro condenser. I think this is a little bit of a play on words here. For you baseball fans out there, you know what I'm talking about. However, nonetheless, they have 100 of these astro condensers in inventory at the beginning of the year. It costs them $10 for each of those. So they have $1,000 of inventory in the store. Okay, that's literally the beginning inventory they have is $1,000 of inventory. As you see, they've been making lots of purchases through that year. They made a purchase in April, a purchase in August, and a purchase in November. So let's take a look at each one. In April, they bought 200 more astro condensers. But look what happened. The cost to those increased. They had to pay $11 each for those astro condensers instead of 10. So they had to fork out $2,200 more in inventory costs for these astro condensers. In August, they bought 300 more, and oh my lordy, it went up again. Now they're paying $12 for each astro condenser. Again, this is the cost to the company, not the price they're selling it to the customer, the cost of the company. So they spent another $3,600 on inventory in August. And then in November, they bought another 400 of those things. Might be a good stocking stuffer down in Houston, don't know. But here we paid $13 a piece for each of those. So they ended up forking out $5,200. So these are all of the purchases that were made. They bought $11,000 worth of astro condensers in those 3 purchases. Again, when you start with beginning inventory and you add all your purchases, you will get all the inventory available for sale. So they have $12,000 of inventory of these astro condensers available for sale that year. Again, as you know, the good news is only 2 things can happen to inventory once you've bought it. At the end of the period, they're either still there, or if they're not there, we assumed that they've been sold. So not only did they spend $12,000 on astro condensers, it bought them a total of 1,000 units that were available for sale. They counted the inventory at the end of the period. They sold, so they still had 450 of those in the store, which means they sold the difference. Okay. So what would be the cost of goods sold? Well, that's what the cost flow assumptions teach us how to calculate. Of the 550 that they sold, what would be their cost of goods sold? Of the 450 that they still have in inventory, what would be the value of that inventory? So this is what we're going to be learning. This is what you're going to be spending your time on. If we use the first in, first out method, FIFO, okay, it means that the first ones on the list, again, you have to look at that inventory list. The first ones on that list are the first ones we sold, okay? So in other words, the first ones on the list are going to be part of our cost of goods sold. Okay, that's basically FIFO. So it basically paralyzes the physical flow of the merchandise that you see on the list. So let's take a look at what it would look like using FIFO on this list. Again, you have to look at the list for any of this to make sense. FIFO means the first ones on the list. The first one on the list is these 100 units from January the 1st. That's the first ones in. They will be the first ones sold in our example. So remember, they had a total amount of 1,000 units. At the end of the period, they had 450 units left. They sold the other 550, right? So again, important to know where these numbers come from. Another thing to know is the book shows you this particular method of, okay, find out what the ending inventory is worth, and then the difference will be cost of goods sold. I will show you that method here. I'll also show you the other method, which is simply to calculate it, from what it is. But we can do that by proving that. So here's the first thing, ending inventory. If the first one in is the first one sold, and we sold 550, all of these are sold. All of these April ones are sold. And 250 of those are sold. Only 50 are left. Only 50 are left. And 400 are all still in the store. So the 450 that are still in the store are 50 from August, and all 400 from November are still in the store. So here you see the 50 from August would have a $600 value. The 400 from November have the $5,200 value. And so we still have $5,800 of inventory in the store. Okay. Well, if you started with 12,000 of inventory and you still have 5,800, you sold the difference. So that's where they get the cost of goods sold. But how can you prove that that number is correct? Here's the other way to do the math, right? You can actually prove that that 6,200 is correct. How? Well, look at the ones that were sold. They sold 550, and the first ones in were the first ones sold. So these 100 were sold. These 200 were sold. So now we have 300 of the 550. We need 250 more of these. So when you take all of these, it's 1,000, plus all of the April, that's 2,200, plus 250 of those, that's 3,000. 3,000 plus 2,200 plus 1,000 is $6,200. So you can actually do it either way. The only thing this book will tell you and ask you is two things. What is the value of ending inventory? And what is the cost of goods sold? Those are the only two questions that this part of the chapter is going to ask you about. And these are the ways you answer it. So FIFO is the first method. It's the most popular method. First ones on this list, first ones out. Cost of goods sold. Okay. This is how it looks in a graphic form. I love this picture so much. I had it framed. It's sitting in my hallway. It's really quite beautiful. As you see, the first ones in, right, are part of the cost of goods sold, right? The $6,200 is cost of goods sold. This is an expense account. Remember, this is going to be on our income statement. The remaining goods are still in the store. This $1,500 is going to be your inventory, which is an asset on your balance sheet. It's current asset. Very important that we make sure this is correct for the sake of our financial statements. Okay. All right, so the second most popular method that's used is called LIFO. It's also what a lot of accountants tell their kids to get. Go get a LIFO. Last in, first out. So the last one's on the list. Again, it starts with that list. If you're not looking at a list, you can't do this. So you're going to look at that list. The last ones on that list are going to be costed out first. So cost of goods sold is determined by the last ones in. Okay. So let's take a look at our list again. Of course, it's going to be the same exact list, right? But under LIFO, the last ones are the first ones out. So the ones that came in for November 27th are going to be part of the ones that have been sold, right? So remember, we sold 550, right? So these last ones have been sold, and half of these 300 are sold because 150 and 400 are 550. What does that leave left? Well, everything else is still ending inventory. So the first step to book wants is what's your ending inventory? Well, you got 150 from August, you got 200 in April, and you got 100 from the beginning inventory, right? That equals 450 units still in the store. You know what the costs are. You add these up. We got $5,000 of inventory still in the store. If you started with 12,000 of inventory and you still have five, you sold the rest. How do you know the 7,000 is correct? Well, we can double check by doing the math as well. So which 550 did we sell? These 400 have been sold at $5,200, and half of these were sold for $1,800. 1,800 and 5,200 is 7,000. So we can actually figure out. And again, I'll go back to this. You're only going to be asked whether what's the value of the inventory or what's the cost of goods sold. It's the only two things that you can answer here with these methods. This is also quite a beautiful picture. I actually have this in my guest room. I forgot who painted it, but it's really beautiful. You should see it. It's fascinating. As you see, the last ones in are the first ones out. And so they become part of your income statement. Cost of goods sold is the first expense on the income statement. That's how that. All the others are still in the store. They're going to be part of our inventory, right? Asset account on the balance sheet, current asset. So this is where we get these numbers from here. The last one, actually, is probably the most straightforward one. Average cost is simply a weighted average. So what do we mean by that? Let's look at our list. We bought 1,000 units of Astro condensers, and we spent $12,000 to buy them. So the average cost of each unit is a $12,000. $12,000 total cost divided by the units, 1,000. 12 bucks per unit. That's the average cost of each unit. So if you only have 450 left in ending inventory, 450 times 12, boom, $5,400 of inventory is still with you. If you started with $12,000 of inventory and you still have 5,400, you clearly sold the rest, 6,600. How do you prove this number? You sold 550, you multiply that by 12, and there you go. This I have in my bedroom. It's over my bed. It's just so beautiful. It's just mesmerizing every night. And so here we have the average cost here in the average tank. And again, 450 units are still in the warehouse, and so you still have that. The other 550 have been sold, and you can verify that number with that as well. What should companies use? Well, depends. Every company has a free choice. This is part of the choices that they have in accounting. As you see here, depending on the choice, there's going to be some differences both in terms of gross profit and net income. The best I would say a company should do is they want to choose the method that provides them with the largest gross profit and the largest net income. And so if I were Houston Electronics, I think FIFO would be the very best method they could use because it shows the highest gross profit. As you know, that gross profit margin matters to investors, and the net profit will be large as well. And so that profit margin is also going to be larger using FIFO. So I think the statistics would show FIFO is the best method that they could use. LIFO would show the smallest gross profit and the smallest net income. Average cost is somewhere in the middle. So that might leave you thinking, well, who the hell would ever use LIFO? Well, it's amazing. There's a lot of companies that do use LIFO. Why would they use LIFO? Because when they use LIFO, their gross profit is large and their net income is larger than if they use the other methods. How can that be? Well, some companies sell things that when they first come out, cost them the most money and cost consumers the highest price. But over time, those prices come down, both to them as a business and to the customer. So this is very typical in tech. Once the newest cell phones, newest computers, newest televisions, newest game, consoles come out, they cost the most, both to the retailer and to the consumer. But over time, those prices will come down, both the costs to the retailer and the price to the consumer. So in that type of sense, a LIFO method would probably be very useful to that type of a company, much better than FIFO. So again, it's totally up to them to choose. It's a free choice, which is so wonderful. Okay. So again, it's important that they consistently use the same methods year in and year out. Some companies can choose to change a method if the cost structure in the business has changed, but they can't be switching on and off. Um, they have to be very, very consistent in what they use. And if they are going to switch, say, from a LIFO to a FIFO, it has to be documented as to why, and they have to keep using it for a long time. So here's the do it exercise, and this is going to help you do your homework. Here's the accounting records for Shumway Ag, which is an agricultural company, showing the following data. They have beginning inventory, 4,000 units at $3. They have purchases, 6,000 units at $4. And then they have some sales. Okay, they sold 7,000 units. All right, so what we're looking for here is, again, what are they asking us for? They can only ask us for two things: determine the ending inventory value or determine the cost of goods sold. So here they want the cost of goods sold using FIFO. So again, you start with your beginning inventory and you add your purchases. Right? So you have 4,000 units of inventory and you had 6,000 units of purchases. So you have 10,000 units available for sale. You sold 7,000 of them. So which 7,000 did you sell under FIFO, right? Because that's how you do cost of goods sold. So my method, I just simply said, which 7,000 did you sell? Well, under FIFO, the first ones in are the first ones out. So you sold these 4,000 units first as part of the 7, and you needed 3,000 more. Okay, those first 4,000 cost you $3. The second 3,000 cost you $4. What's your cost of goods sold? You simply do a little bit of a formula. Whoops. And you'll see the 4,000 units at $3 have been sold, and 3,000 units at $4 have been sold. Total $24,000 cost of goods sold under FIFO. Okay. What's left in inventory? 3,000 of these units at $4 is left in inventory. Because that's the only two things that can happen, right? You had 10,000 units, 7 are sold, 3 is still with you. What if we use LIFO? Yeah. What if we use LIFO? Well, here, the last ones in are the first ones out. So those purchases are the last ones in. They'll be the first ones out. So of these 7,000 that we sold, under LIFO, we sold these 6,000 first, and we needed 1,000 more from the beginning inventory to match their 7. So 6,000 at $4, plus 1,000 more at $3 will give you the 27,000. Let's see what the math looks like. The math is wrong. This is 24,000. That's correct in the book. It's just wrong on the slide. Okay, very good. So that would be our cost of goods sold if we used LIFO. Average cost. Okay, well, think about it. Average cost, right? Remember, there's always got to be some way of figuring things out here, if you know what I mean. So we had $36,000 of total inventory, and that bought us 10,000 units. So what is the average cost of each unit? $3.60, right? So $3.60 is the average cost of each unit. Again, this is the book model. They take the beginning, what your total minus the ending inventory. This is not dollars. A lot of mistakes on these slides. 3,000 units at 360, that's subtracting the ending inventory to get the 25,200, or you can simply take the 7,000 multiplied by 360 and it should also equal to that. So remember, one way or the other, there's always some way of figuring these things out. I don't know if you have some questions. Okay, I'll stop.